Snap-on Incorporated, ticker symbol SNA, is one of the world's leading manufacturers of professional tools, diagnostic equipment, repair information, and specialized equipment. The company has built a powerful brand among professional automotive technicians and other skilled workers by focusing on durability, reliability, and productivity rather than competing primarily on low prices. Snap-on generated approximately $4.7 billion of revenue in 2025, and the company entered 2026 with strong margins, substantial cash generation, and a long history of returning capital to shareholders. In this analysis, we will look at Snap-on's business, financial performance, growth opportunities, risks, valuation, and my 2027 price targets. Snap-on operates through several major businesses, including professional tools, repair systems and information, and financial services. Its famous franchisee-based mobile tool network allows technicians to purchase tools directly at their workplaces, creating a close relationship between Snap-on and its customers. The company also sells advanced diagnostic systems, repair information, and specialized equipment. This business model gives Snap-on an important competitive advantage because professional technicians often prioritize quality, reliability, and productivity over simply choosing the cheapest product. Snap-on's biggest strength is profitability. In 2025, the company generated approximately $4.7 billion of revenue, while maintaining operating margins above 20%. Revenue growth was relatively modest, but the company continued to generate substantial operating earnings and free cash flow. This tells us something important about SNA. It is not a high-growth company, but it is a highly profitable, mature business that can continue increasing shareholder value through margins, dividends, acquisitions, and share repurchases. The second quarter of 2026 showed some improvement in the growth picture. Snap-on reported approximately $1.24 billion of quarterly revenue and diluted EPS of $4.96. Organic sales growth was around 3%, while profitability remained strong. The improvement in operating performance is important because Snap-on does not need explosive revenue growth to increase earnings. If the company can combine modest sales growth with pricing, productivity improvements, and operating leverage, EPS can grow faster than revenue. For 2026 and 2027, I see several important growth drivers for Snap-on. The first is continued demand for professional tools. The second is the growing importance of vehicle diagnostics as modern vehicles become more electronically sophisticated. The third is expansion into adjacent professional markets, such as aerospace, manufacturing, and other specialized industries. The fourth is international expansion and acquisitions. Finally, pricing power and productivity improvements can continue supporting earnings, even if overall revenue growth remains moderate. One of the most important long-term opportunities for Snap-on is diagnostics. Modern vehicles are becoming increasingly dependent on electronics, software, and sophisticated computer systems. That means technicians need advanced diagnostic equipment and repair information to identify and fix problems. Snap-on is well positioned in this area because it already has strong relationships with professional technicians. The company's acquisition of Diesel Laptops in 2026 also expands its capabilities in diesel diagnostics, repair information, and training, potentially creating another avenue for future growth. Snap-on's competitive advantage comes from its brand, product quality, franchisee network, and relationships with professional technicians. A mechanic who depends on a tool every day may be willing to pay more for a product that is reliable and durable. Snap-on's mobile franchisee network also provides convenience that is difficult for competitors to replicate. Over many decades, the company has built a reputation that gives it pricing power and helps protect margins. Snap-on's financial services business is another important part of the investment story. It provides financing that helps customers and franchisees purchase expensive professional equipment, while also generating significant earnings for the company. This business supports the core tool operation and adds another source of profitability. However, investors should remember that financial services also introduces credit and interest rate risks, so this segment needs to be monitored carefully. For me, margins and cash flow are more important than revenue growth when analyzing Snap-on. The company operates with strong profitability and relatively modest capital requirements. Management has historically used its cash generation to fund dividends, acquisitions, and share repurchases. If Snap-on can maintain strong margins while generating consistent free cash flow, the company can continue increasing EPS even if revenue only grows at a low single-digit rate. Snap-on also has an attractive shareholder return strategy. The company pays a regular dividend and continues to repurchase its own shares. In 2026, Snap-on announced an additional $500 million share repurchase authorization. Buybacks are particularly valuable when the company purchases shares at reasonable valuations because reducing the share count can increase earnings per share over time. Combined with dividend growth, this can provide shareholders with an additional source of total return. For 2026, my base case estimate is approximately $4.8 to $4.9 billion of revenue. I expect low single-digit revenue growth, supported by pricing, modest organic growth, diagnostics, and acquisitions. For EPS, my base case estimate is approximately $19.7 to $20.1. The key factor will be whether Snap-on can maintain its margins while gradually improving organic sales. For 2027, I estimate revenue could reach approximately $4.95 to $5.05 billion in my base case. EPS could reach approximately $21 to $22. If organic growth accelerates and the company successfully integrates acquisitions, EPS could potentially move toward $23 to $24. However, I would not build the investment thesis around extremely aggressive growth because Snap-on is a mature industrial company. At a stock price around the low $400 range, Snap-on is trading at roughly 20 to 21 times earnings, depending on the exact price and earnings estimate used. For a company growing revenue at a relatively modest rate, this is not a cheap valuation. However, investors are paying a premium because Snap-on has strong margins, a powerful brand, consistent cash generation, dividends, and share repurchases. Therefore, the stock can still perform well, but the entry price becomes extremely important. Using a conservative discounted cash flow framework based on Snap-on's earnings power, free cash flow, moderate long-term growth, and an appropriate discount rate, I estimate fair value at approximately $360 to $430 per share, with a midpoint around $395. This suggests that the stock is not obviously undervalued around $400 to $420. Instead, the market is already recognizing much of the company's quality. A meaningful decline without a deterioration in fundamentals would therefore make the risk-reward more attractive. In my bear case, Snap-on could be worth approximately $340 to $360 by 2027 if growth remains weak and the valuation multiple contracts. In my base case, I see a 2027 price target of approximately $430 to $460, with $445 as my central target. In the bull case, stronger organic growth, margin expansion, successful acquisitions, and continued buybacks could push the stock toward $500 to $540. An extreme bull scenario could reach $550 to $575, but I would not use that as my primary forecast. The biggest risk is slow revenue growth. If Snap-on remains stuck around 0 to 2% organic growth for several years, investors may eventually be unwilling to pay a premium valuation. Another risk is a downturn in automotive or industrial activity. Financial services also carries credit risk, while currency movements can affect international results. Over the long term, the transition toward electric vehicles could reduce demand for some traditional mechanical tools, although the growing need for diagnostics and specialized equipment could offset part of that pressure. I would become more bullish if Snap-on consistently delivered 3 to 5% organic revenue growth while maintaining or expanding its operating margins. Strong growth in diagnostics and repair information would also be a major positive. Successful integration of diesel laptops could create additional growth opportunities. At the same time, continued share repurchases at reasonable valuations could accelerate EPS growth. These factors could justify a higher valuation multiple and push the stock toward my bull case target. My 2027 valuation framework is straightforward. The bear case is $340 to $360, based on slower growth and multiple compression. The base case is $430 to $460, with $445 as my central target. The bull case is $500 to $540, assuming stronger earnings growth and continued margin expansion. My extreme bull case is $550 to $575, but that would require significantly better execution and a premium valuation. So, what is my rating on Snap-on? At approximately $400 to $420, I would rate SNA a hold watch list rather than an aggressive buy. The company itself is excellent, but the valuation already reflects a significant portion of that quality. If the stock falls toward the $360 to $390 area, while the fundamental outlook remains intact, I would become much more interested. At $430 to $460, I believe the stock would be reasonably valued under my base case, while prices above $500 would require stronger than expected earnings growth. Overall, Snap-on is a high-quality industrial company with a powerful brand, strong margins, loyal professional customers, attractive cash generation, and a shareholder-friendly capital allocation strategy. The biggest limitation is not the quality of the business. It is the relatively slow revenue growth and the valuation investors are currently paying for that quality. My 2027 base case price target is $445, with a bear case of $340 to $360 and a bull case of $500 to $540. So, can Snap-on become a $500 stock by 2027? Yes, but the company needs continued earnings growth, margin strength, and successful execution. At the current valuation, I would be patient rather than chase the stock. But if SNA experiences a meaningful pullback without a major deterioration in fundamentals, it could become a much more attractive long-term opportunity. If you enjoyed this analysis, make sure to like the video, subscribe to the channel, and turn on the notification bell so you don't miss our next stock analysis. As always, do your own research before making any investment decision. Thanks for watching, and I'll see you in the next video.